Hello, we're waiting just a minute for the room to fill up. It looks like the number is leveling off, so we're expecting a few more, but they'll just have to pick up from where we are. So good morning, good afternoon, depending on your location. So today we're going to talk about discount rates and what are the latest numbers and how do they affect your lump sum. And we're going to focus on the ExxonMobil system. If you're not with ExxonMobil, you're welcome to stay. And most of what we say is going to apply to you, but some of the details might be different if your pension is with a different company. So obviously, I'm not the good-looking guy whose picture is on the front page. That's our CEO and president. I'm one of the financial advisors. I'll talk a little bit more about myself in a couple of slides. First, just a few words about who we are, Bogart Wealth, in case this is your first time joining us. So we are a registered investment advisor, and that basically means that we're supervised by the Securities and Exchange Commission, the SEC, that we have a fiduciary duty to act in your best interest. I'll say a few more words about fiduciary duty in a minute. Our clients have their accounts at Charles Schwab, and then they give us a limited power of attorney to buy and sell on their behalf in their accounts or to transfer money between accounts that's already registered to them. If you're interested in how big we are, 1.4 billion of assets that our clients own and entrust under our advisement. So what does fiduciary mean? It means we have a legal responsibility to put your interest ahead of our own, which means to provide full disclosure, to always act in good faith. If there's any conflicts of interest, that's part of the disclosure. We need to be transparent about fees, etc. So this is our team, the advisors on the top row. So you can see I'm one of the advisors. Before I joined Bogart Wealth, I worked at ExxonMobil. So I've gone through the ExxonMobil retirement process myself and happy to talk to you about it anytime. And you can see we have a couple of associate advisors who help the full-time advisors keep focused. And then we have back office team that deals with the interface with Schwab and your banks, and also people full-time managing the portfolios. Separately, we have a tax team. Oh, by the way, this isn't everybody on the team. There's a couple of new people whose pictures are missing, and there's a couple of new people on the tax team whose pictures are missing as well. But one of the questions we often get is, will you file my taxes for me? And the answer is yes, if you want us to. I don't know about convenience, but we have 3 locations. So started out in McLean, Virginia, and focused on this one office complex on Gallows Road in Fairfax, Virginia. You might have heard of it. Figured out that at some point we're going to have to start getting clients in Houston. So opened an office in Houston. I was one of the first clients from Houston. And then, of course, it became obvious in more recent years that we needed a presence in the Woodlands. So biggest office is still McLean. The second biggest office is the Woodlands. And then I'm in the smallest office out here in West Houston. Our mission is to help clients achieve financial peace of mind by maximizing and preserving intergenerational wealth. So intergenerational wealth means, for example, I have met with clients' parents or clients' children if they need financial advice. They're part of the family. It's not all about maximizing how much money we're managing. It's about helping the client achieve financial peace of mind. So that's part of the estate and multi-generational planning. But you see, we do so much more than just investment advice. So you can read that another time. The not so hidden motive of us doing these webinars is to entice you to come in for a one-on-one financial strategy session. Well, I said come in, could be a Zoom meeting. So that's a not so hidden objective. It's free, it's no obligation. And I know from being a pricing advisor at ExxonMobil that a lot of times people think free means no value, but you will find exactly the opposite. You will be amazed at the amount of value you can get from us for free. This is part of a series that we do. We call our Retirement Readiness Series, about planning for retirement, more specifically income planning, Social Security, tax laws, estate planning, that little thing called NUA, and other post-retirement strategies, long-term care planning, Roth versus traditional 401ks and IRAs. And by the way, next week, this is the topic on the agenda. And then backdoor Roth conversions, including the mega backdoor Roth conversion. So we have this series. I'll talk later about how you can sign up to get the notifications for these. But let's get into today's topic, which is how do these discount rates affect my ExxonMobil lump sum? And by the way, what's going on with interest rates? I should mention we have the Q&A and the chat open. So if you have questions, pop them up anytime and I'll get to them as I can. So the first thing to know about how interest rates affect you is to understand that there was this thing back in 2006 called the Pension Protection Act. It always kind of worries me when the government wants to protect me from my pension, but okay, so be it. It limits the company's ability to offer lump sums. So for example, if a company is not, their pension plan is not funded at least to 80% of actuarial level, they cannot offer 100% lump sum. They can only offer a 50% lump sum. And if they're not at least 60% funded on an actuarial basis, they cannot offer a lump sum at all. They can only offer annuities. Okay. You know, happily, ExxonMobil has never been anywhere close to only 80% funded. They get to 90% funded, they get bad press. So they tend to stay close to 100%. But that's one of the things in the act. Another is it defines the discount rates that can be used. So a lot more detail is coming on that. It defines the actuarial table to be used. So a little more detail coming on that. It said that non-spousal beneficiaries can do rollovers. Well, okay, but in 2000, another law came along that made this much less good as it used to be. It said after-tax balances can roll over to the Roth IRA, so that was new. And it said that the company match could be diversified. So, okay, I know at the moment there's no company match, but we're all looking forward to it returning. And you probably remember when to get 7%, the company match had to go to company stock. This law said, you really can't write laws like that. And so the plan said, okay, everybody gets 7% no matter where they put it. And most people never got the news and they're still putting the 7% in the company stock. But okay, that'll be important to you when the match comes back. And then it defined 401k and IRA contribution limits. Not that there were no limits before, but it updated the law for those. So basically, that means now that there are two categories of people: the people who are grandfathered for the Pension Protection Act and those who are not. So the ones who are grandfathered for the Pension Protection Act are those who were within 5 years of being eligible for retirement at the end of 2007. Okay, so that means that by January 1st, 2008, you had to be at least 50 and have 10 years of service, okay? Or another way to think of it is 55 and 15 by December 31st, 2012. Or another way to think of it is born before 1958 and hired before 1998 and have no gaps in your service since 1998. Really important point. So if you're grandfathered, then you're still using the 30-year Treasury bond. And if you're wondering where to find the data for the 30-year Treasury bond, so here it is. I would just do a Google search for FRED. Okay, that's the Federal Reserve Economic Database. And you can just put in 30-year Treasury, or you can put in this symbol DGS 30. Or of course, you can get a copy of this seminar, and you can click on the link. And then it's rounded to the nearest 0.25%. So I'll show you some examples of that in just a minute. That's all good. What it's not so good is it's stuck in concrete, and it's still using the year 2000 mortality table, even though people are living a little longer now, 20 years later, it's still stuck using that. Okay, so I have a question. Did this specific rule, and I guess we're talking in general about the Pension Protection Act of 2006, did it just affect companies that have a pension? And yeah, for sure, it only affects companies that have a pension. And you know, there's not nearly as many as there used to be, right? So if you go all the way back to the 60s, you probably had 75% of large corporations in the US that had a pension plan. Now, fast forward to the present, it's only about 25% have a defined benefit pension plan, and most others have transitioned over to they have a 401k, and that's it. So if you don't have a pension plan, none of this applies to you. Now, if you do have a pension plan, then when this 2006 Act became effective in 2007, you had to decide whether you were going to grandfather people or not. And you could decide how to grandfather people. But the law said you have to have people switched over to the new system within 5 years. So ExxonMobil said 5 years, great. Anybody who's eligible to retire within 5 years, so by the end of 2012, if you're eligible to retire by then, we're going to grandfather you. So this is the convoluted way that ExxonMobil wrote their definition of grandfather. So if you're not with ExxonMobil, your company may have a different definition of grandfather. Okay? All right, so for those who are grandfathered, we're following the 30-year Treasury bond. Yeah, this is what it's looked like on a daily basis going back to the 1980s when Reagan was president, down to the present time. And you see ups and downs with economic cycles, but you also see a major trend down, 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 down. And every time we hit a new low, somebody says it can't go any lower. Okay. I've stopped saying it can't go any lower a long time ago. We have a long-term trend here. All right. So the data, let's look at the most recent. So the current quarter's data is going to apply to the fourth quarter. So there's always like a dead quarter in between. You capture the data, you have a quarter to think about it, and then that data applies to the following quarter. Okay, so the quarter we're in right now, the second quarter of 2021, the discount rate, 1.5%, is based on the average of the numbers during the fourth quarter of last year. So that average was 1.6190. You take 95% of it, and then you round it up or down to the nearest quarter point. Okay? Now, sometimes people like to take a monthly average and then average those three numbers. And most of the time that doesn't matter. But if you're really close to, do you round up or down? That's not the right way to do it. Each day counts the same number. And then knowing how many days are left in the quarter, you can say, well, what would the average have to be for this 2.25 that we're projecting already to be the effective number for the fourth quarter of 2021? How high would it have to be to get us up to 2.5, or how low would it have to be to get us down to 2.0? Okay, and you can see that from where we are, it's actually more likely it'll roll down than that it'll roll up, right? Okay, and you can actually see that the last data point on here was quite a bit lower than the ones before it. Okay, so that's where we are for the grandfathered folks. We hit a minimum last year. Second and third quarter last year were the lowest rate ever in the history of mankind. When Christ was throwing the bankers out of the temple, they were charging much higher interest rates than this. Okay, so the discount rate has been coming up in the second quarter. It's up further now in the third quarter, and it's projected to go even further in the fourth quarter. Stepping up every quarter is what this is doing. And by the way, if you look at it over time, you know, when it swoops down and hits a low, it does tend to come back up. So the last all-time low was here in 2017, and by the end of 2017, it popped back up. So will we ever see 1.25 again? I have no idea. Okay. But I wouldn't be too surprised. Everyone else is subject to the new Pension Protection Act. So that means you were under 50 on December 31st, 2007, or you were born after 1957, or you were hired after 1997, or maybe both. For those people, we're using, instead of that one nice simple chart of the 30-year Treasury bond, we're using 3 segmented rates based on the high quality corporate bond yields. Okay. Now, even though these are the highest quality corporate bond yields and therefore lower than the average corporate bond yield, corporate bonds are always going to have higher yields than Treasury bonds, unless, of course, the US Treasury decides to default someday, and then who knows what's going to happen. So this is where you can find those. And I'll just show you what that website looks like. So you can see they have them there by month. And then what you would do is take the last 2 months of the quarter and average those numbers together. And that will be not the next quarter, but the quarter after that. So basically March just ended. March just got published last week. And so now we know what the discount rates will be for the third quarter. Okay, so higher yields are bad, but it uses a mortality table released by the IRS. It gets updated all the time, and people are living longer than they were 20 years ago. Longer life is good. Of course, once the numbers come out from 2020 and all the people who of older age that died from COVID might very well affect those numbers. We'll see. Now, even though the IRS publishes this every year, the company does not have to change tables every year. They have to update at least once every 10 years. And the last time that they updated was 2018. So they don't have to update their tables until 2028. They can, but they don't have to. So from what we've seen so far, they're still using the 2018 table. So these new rules first affected people in 2013. We started seeing the first people who were 55 and 15 and therefore affected by these new rates. And I guess if you think about grandfathered folks, so they have to be like 63, 64 now to be grandfathered. And so a lot of them have already retired. We're not seeing that many grandfathered people. Still a few, but not that many. So most of the people we talk to, we're working with these segmented rates. This is kind of what the history of the segmented rates look like. And actually, you know, the reason we made this chart was to look at how our predictions are working relative to the actual numbers. So like right in here, you can see that the actual numbers were coming in a little bit higher than our predictions. Here you can actually see this moved in an opposite direction than we predicted, which is kind of crazy. But most of the time, it's within the width of the data point. You know, we're not off by much. And so we're able to give pretty accurate predictions of these things as the quarters progress, instead of having to wait till the end of the quarter and actually a half a month into the next quarter before we know the numbers. So on a little bit more granular basis, same kind of thing, data from the second quarter, there's a gap, it applies to the fourth quarter. Okay. Okay, so I got a question that came in. It was back here on me talking about mortality tables. And the question is, if ExxonMobil updated to a more current actuarial table, would that be a benefit? So they're using the 2018 table. The 2019 table is maybe just a tiny bit advantageous. And the 2020 table, like I said, when that comes out, and it includes that fact that if you're 85 or above, you're much more likely to die of COVID. If you're 75 and above, well, you're still more likely to die than somebody who's 65 or younger. Yeah, I don't think that's going to help. I think that's going to be bad for the lump sum. So longer life is always better for the mortality table. And we'll get into why that is in a minute, so you can see kind of, well, just how good is it? Okay. So it's the same kind of the data from this quarter, there's a dead quarter, and then it applies, okay? But it's much more complicated because it's got these three different segments. And I'm going to show you how to use those segments to kind of understand their importance in just a minute. But because very few people want to go through the complications of what I'm going to show you in a minute, they find it a lot easier for us to publish these single rate equivalents. Okay, so in order to get the same lump sum using a single number for your discount factor, what would that number be? And it depends on your age. Okay, and that's going to become more clear to you in just a minute. But the people who retire at 70 actually, at 60 actually have like a lower discount than the people who retire 55. Now, when you go to buy something, you want the biggest discount you can get, okay? But in this case, you're the one receiving the money. You would like a smaller discount, please, okay? So because these things don't always move in the same direction and certainly don't always move by the same amount, we find it a lot easier to just compare these single rate equivalents. And what you can see is from the first quarter to the second quarter this year, there was just no discernible difference. Maybe in the third or fourth decimal place, there's a difference. But as far as you can see, there's no difference. And it's popping up for the third quarter, significantly by 42 basis points. Now it's really, really, really early, so don't get hung up on what this says about the fourth quarter. You know, yeah, it may be going up that much. Yeah, but it may not. So it's way too early, and I'll talk a little bit more about that in a coming slide. Well, this would be that coming slide. So this is our going back in history, what we think the single rate equivalent would be. These are daily points again, but then put the quarterly points here. So the quarter always lags by a quarter, right? So it's shifted over to the right. And you can see, for example, how rates shot up. Well, they shot up back here in 2008, didn't they? We had a financial crisis related to bonds. So nobody wanted to buy bonds for a while, and that meant that interest prices went down, interest rates went way up. Same thing happened last March. People were just dumping everything, and that included their bond funds, and that made the prices of bonds go down, and that made their interest rates go way up. Okay, but right after that, when the Federal Reserve came in with fire hoses full of money and said, anybody who, even if they're not creditworthy, will lend them money. Okay, all of a sudden, nobody's worried whether their bonds are going to get paid or not. Interest rates go way back down. And what you see is you didn't even see that blip in the quarterly numbers. They just, that high and low averaged out to about the same, and then it dropped, and then it dropped some more and some more, and here it's popping back up a little bit. But if you look at the daily numbers, you see that the April numbers are actually coming in lower than March ended. All right. Who knows if that trend's going to continue, but the reason March popped up by so much was enthusiasm over vaccines and concern about inflation caused by the latest government stimulus. Well, I can tell you every time there's government stimulus, somebody claims there's going to be inflation. But if you look at this over a long period of time and kind of in your mind take out financial crises, you see the same thing you see with Treasury bonds. This is a sloping curve. In long-term, interest rates are going down, not up. And that'd be a long conversation to talk about why that's happening. Can it go on forever? Yeah, well, probably not. So anything that cannot go on forever will someday end. Is it going to end any day soon? I have no idea, but I don't think so. I'd love to spend hours talking to you about why I don't think so. Okay, so how does all of this work? So I'm going to illustrate this with someone who's retiring now in the second quarter. So either May 1st or June 1st is their benefit commencement date. So they're getting the lowest equivalent rates in history. So these are their three segmented rates. I wanted it to come out to a nice even number of $1 million lump sum. So I back calculated that into their annuity is $4,581.89 a year. That would be the single life annuity with 5 years certain, translating into $54,983 a year. Okay. The life expectancy tables say they're going to live to about 84. And I can't do about in my table. So I'm doing precisely 84. They are going to die on their 84th birthday. So the last year we have in here is their 83rd year. And so for each year, we have an annuity payment. We have an interest rate that applies to it. So segment 1 applies to the first 5 years. Segment 2 applies to the next 15 years. Everything after 20 years is going to be segment 3. Now, this is why a person who's 55 is going to have a higher effective discount rate, because this 5 years is 55 to 60. Okay. And then these years only take them up to 75. And you've got about 5 more years left at this highest discount rate. Okay. So when you're going to back calculate their single equivalent rate, you're going to end up with a higher number because you had more of the highest number applied to them. Now, of course, nobody knows when you're going to die. All right. Half of you will live longer than 84 and half of you will not make it to 84. Nobody knows that, but everybody gets the same life expectancy from an actuarial standpoint when they're calculating this. Well, not everybody does. Everybody who was born on the same day has exactly the same life expectancy. That's a better way to say it. Okay, so these discount rates are basically 1 divided by 1 plus 0.52%, and then divided by 1 plus 0.52% squared, cubed, to the 4th power, to the 5th power. And now you see here, you can almost do this in your mind. This is 100% minus 0.52, minus 1, minus 1.5, minus 2, minus 2.5, okay? But here it jumps by a lot. And the reason it jumps by a lot is the way to think about this is how much money would I have to invest today at this interest rate so that in the 6th year, I will have the 55,000 or 54,983 to be able to pay. Okay. And the answer is 47,998. Okay. So in other words, it's not taking this 2.29 and applying it to the 97%. It's taking the 2.29 for all 6 years in order to get that discount factor. Okay. Then you add all that up and you get $1 million. If you're following me, I've got really bad news for you. And that is, this was a simplified example to illustrate the impact of age, life expectancy, and interest rates. This is not exactly how they calculate the number. And if you use this methodology, I'll tell you, you're only going to be within 1%. 1% is pretty good for financial planning purposes over a 30-year horizon or a 40-year horizon. On the other hand, 1% of $1 million is $10,000, and nobody wants to be off by $10,000. So there are more complicated ways you can do this, but I'll tell you, the simplest way is you go online, you use the pension projection tool. Okay, I know some of you would say, Pete, I can't use the pension projection tool because of X, Y, or Z, and I have to get mine done by human resources. Well, I would say, give us 1 or 2 you've had done by human resources. We'll be happy to do the interpolations and extrapolations for you and show you how all these factors actually affect you. Okay, now, continuation of the previous example, the person getting $1 million lump sum with the lowest discount rates in history. And we want to see what happens if interest rates go down or if they go up. And I'm only illustrating going down by 1% at most because these are pretty low. But I'll illustrate going up more than 1. Okay, so base case is $1 million. And you can see that as the interest rates go down, 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 that the lump sum goes up, 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 up. And the rule of thumb that I use, and I've been using this, by the way, since like 2006, when the new law came out, and I said, you know, it's about a 1% difference between Treasury bonds and corporate bonds. How much of a change in lump sum is that? And I came up with 10%. I've been using that rule of thumb now for more than 10 years, almost 15 years. And it continues to be about right. Okay, so 1% decrease off of the lowest interest rates in history would be another 10, maybe 11% on your lump sum. So that's $100,000 off of $1 million lump sum. Interest rates go up by 1%. By 1%, I'm sorry. Then the lump sum goes down by that same almost $100,000. Okay. Now, if it goes up by 2, it can't possibly continue to be that 1% rule of thumb, because if that were true and interest rates went up by 10%, the lump sum would go to 0. So that can't be true, cannot be true. But within the range of 0 to 1%, which year over year, you almost never see a change of more than 1%. You know, this past year was historic change. And if we look at the single rate equivalent, the end of 2019, it was 3.6. Okay, it went down 1.3%, but that's still over more than a year. Okay, so within kind of the normal range of movement, this is a really good rule of thumb. 1% change in discount rate, 10% change in lump sum. Half of that is half of that. There's half of that. Okay, a tenth of that is a tenth of that. So what we're talking about, the change between second and third quarter. So a benefit commencement date of July 1 versus June 1 is 42 basis points. So use a rule of thumb, that's 4.25% on $1 million lump sum. That's $42,000. That's a lot. Okay, but maybe your salary is more than $42,000 if you worked another 3, 4, 5, 6 months. So it doesn't say that, well, you've got to retire. You got to retire. No, it's only one piece of the whole puzzle. Okay, just one piece of the whole puzzle. But that's how much a change in interest rates are going to affect your lump sum. By the way, I've worked this example for somebody who is not grandfathered, but the same percentage changes are going to apply for somebody who is grandfathered. Okay, exactly the same. So people, if they're not yet 60 in particular, will ask the question, what if I retire now and delay taking the lump sum? And by the way, if you take the lump sum, you're probably going to roll it over into an IRA. And if you pull money out of an IRA before age 59 and a half, which is pretty close to 60, then you're going to have to pay a 10% tax penalty. Now, there are exemptions and exceptions, and we have ways to finesse that. But still, it's not a bad mindset to say, okay, what if I was going to retire now, but delay the lump sum? So when would you consider doing that? Well, certainly one thing would have to be, I don't need the money right away. If you need the money right away, that's not an option. Particularly if you're retiring before 60. And why is that? So we all know that if you take the benefit before 60, it's not retiring before 60, but take the benefit before 60, there will be a 5% per year reduction off of your basic pension. 5% a year. So retiring at 55 is a lot harder because it's a 75% haircut off of your pension in the first place. Okay. But if you've saved enough money that you can afford to get to at least 59 and a half or 60 without needing to touch that lump sum, then the question would be, why don't I just wait? I'll get that 75% back. Well, you won't really. Okay, so you will really get that 25% back if you wait till 60 and take the annuity. But the lump sum is different. Why would the lump sum be different? Okay, let's go back to this table. And remember I said, if you retire at 55, you got to add 5 more years to the bottom of this table. So the annuity payments would be lower, but you'd get them for longer. Okay? To a first approximation, you will get them for 5 years longer. 5 years out of 84 minus 60 is 24 years. That's 20%. That's more than 20%. Okay, but it's not quite that good because those years that you get come at the end, and you can already see they're only worth about half of what a year at the beginning is worth. So let's just say it's 2.5 years more that you get out of 24 years. That's 10%. So you're going to get 10% back because you took the lump sum instead of the annuity. So waiting until 60 is not quite as good, but it's still pretty good. It's still 15% improvement on the lump sum, as long as interest rates don't change. Okay, so when to consider delaying is at 1 and 2, you're taking the lump sum and you're expecting interest rates to fall. Okay, now obviously if you're taking the annuity and you can afford to wait, you go ahead and wait. You're going to get 5% a year. There's no question about it. You're going to get 5% a year if you can afford to wait on taking the pension. And by the way, when you defer the pension, you don't tell them, well, I'm going to take the lump sum, but I'm waiting. They're like, well, that's very interesting, but it doesn't matter. If you're waiting, you're waiting. You don't make the decision lump sum versus annuity now, but wait to take it. You wait to take the pension. And when it's time to take the pension, you have the option of lump sum versus annuity still. Now, I'm assuming you're retirement eligible. Okay, so there are people, as you know, who have left the company recently who were not retirement eligible and have an option to take a lump sum. That option expires within 3 months of separation from service. So they can delay taking the pension, but the rules are totally different, and they will not have a lump sum option at their pleasure. They might be offered one again sometime in the future. They might not. They can't count on it. Okay, so those rules are different. This is just for retirement eligible people, what I was talking about in this slide. Okay, roadmap for someone who says, oh my goodness, I didn't realize interest rates were going up that much. I didn't realize they were going to affect me that much. I guess I need to leave in the second quarter here. The latest benefit commencement date I can have is June 1. What would my roadmap look like? Okay, so what we did was we took, this is a nice colorful version. I like the engineer's version over here on this page. We took, you want the check to show up right around June 1st, and back up from that you have to have the package back to benefits 35 days prior to that. 30 of those are federal law. The extra 5 is ExxonMobil's belt and suspenders approach, or to be kinder, to say that if there's something simple that can be fixed within a day or two and still get under the federal 30 days, then it's Mother ExxonMobil being kind to the bear cubs. But okay, 35 days prior to benefit commencement to get the check on time. If you miss that 35 days, it doesn't mean you don't get the check. It means you don't get the check on time. It doesn't mean you don't have a June 1st benefit commencement date as the date of record for calculating things, but it means it isn't going to show up on June 1st. Okay, so back up to 35 days. So in order to get that in 35 days in advance, well, you have to have the forms to fill out. Okay, so you have to get the package delivered to you. They used to tell you 4 to 7 weeks. In fact, they may still tell you 4 to 7 weeks, but unless you had a messy divorce with a quadro, you are probably going to get it a lot faster than that. Sometimes now within 1 week. Okay. So it's still in theory possible for you to get this 35 days in advance. Yeah, I don't think it's going to happen. We only have 6 days to go. But okay. So you could still get the June 1st benefit commencement date, but your check is not going to show up on June 1st. And by the way, that happened to me because I made a mistake in my package. So if you come meet with me to review your package, I will absolutely guarantee you will not make that mistake or any other that we're aware of. Okay. So basically, you can request your intent to retire package as early as 120 days in advance. Generally, it's recommended you do it at least 90 days in advance. But these days, they're doing things faster. And I'm telling you, 45 days in advance, you might still get your check on time. All right, the rest of this has to do with rolling out of Voya. Not everybody rolls out of Voya right away. Let's skip that for today and leave that for another seminar that has a broader topic area. Okay, so any questions on what I've covered? Because I'm going to kind of slide out of that and into some more generic stuff. Okay, well, if you're still formulating a question, I'll look back at the Q&A as we go along. So people always want to ask, okay, what can I do now to prepare? And so the most important thing is to have a plan. And the most important part of that plan is to have a budget. Okay. So a question did come up, and that is, do I plan to talk about how being Heritage Mobile impacts you? And particularly when it comes to lump sum and annuity. So no, I wasn't planning on it, but I think I will. Okay, so when your Heritage Mobile or Heritage anything else, okay, it could be Santoprene, it could be Paxon, it doesn't matter. You're vested in one part of a pension program, and that company now is owned by ExxonMobil, and you have the option of taking it all together or into separate pieces. And in one or two of these, you don't actually have the option. You're going to get the separate pieces. But for Heritage Mobile, for sure, Santoprene is another example. You have the option of taking it as a combined pension. And everything that I've talked about has been if you chose to take it as the combined pension. So why would you take it otherwise? Well, for one thing, the way Heritage Mobile treated the Social Security integration was different from the way that Heritage Exxon and now the ExxonMobil plan covers that integration with Social Security. Not a big deal. Most of it had to do with just how they talked about it. Because ExxonMobil talks about it in terms of the lower amount you're going to get for the rest of your life. And oh, by the way, in a footnote somewhere, if you take the annuity, you get it paid the rest of your life. And in a footnote somewhere, they mention, well, if you take the annuity between now and age 62, we're going to give you a little extra. Whereas Heritage Mobile talks in terms of it is, this is how much we're going to give you total right now. At 62, it's going to go down a little bit. So that's not really a big difference. But the different options, other than just taking the basic pension. So somebody who's married is almost always going to take a joint, if they're going to take an annuity at all, they're going to take a joint annuity. And so you have some slightly different options. But at this point, it's been 20 years. The Heritage Mobile piece is going to be relatively small compared to the 20 years since then. And so, okay, it's also another way that you could say, well, I don't want 50-50 lump sum annuity. I don't want 25 lump sum annuity. But what I want is the ExxonMobil lump sum and the Heritage Mobile annuity. That number I like. Okay. So it gives you like one other option of how to split the baby. But generally speaking, if you look at the two lump sums and add them together, it will be very close, but a little bit less than the combined ExxonMobil lump sum. So generally speaking, for someone who wants to take the lump sum, compare adding the two numbers together with looking at the combined number. You're probably going to go with the combined number. And that's why I tend to just talk about the combined number, because I've frankly never seen anybody take a lump sum and take the two separate pieces. I have seen them say, well, I'll take the ExxonMobil lump sum and I'll take the Heritage Mobile annuity. I have seen that. Okay, great question, Tom. So I was on what can you do now that will improve your feeling ready, your readiness for retirement. So definitely having a plan, and the most important part being the budget. You can't really do a lot about what the future of financial markets are going to be in aggregate. But understanding your spending is a really, really, really good thing. And I would say if you're married, having an agreement on the order of your priorities, having your priorities written down and agree on the order of them. And I'll give you an example of that. When we do plans for people, we almost always, unless they absolutely scold us and tell us to do otherwise, we're going to do a lump sum case, and we're going to do an annuity case, we're going to compare them. Well, let's assume you're not going to run out of money. Okay? If you're not going to run out of money, you're starting with more with the lump sum, you're going to end with more with the lump sum. And a lot of people have in their mind, it's going to be so beautiful to leave that money to my kids. Not everybody feels that way, of course, but a lot of people do. And okay, so the lump sum looks like it's going to allow you to leave more money to your kids. I would go back to, what are my priorities? And if one of your priorities is never become a burden on my children, and another one is leave money for my children, which of these two is a higher priority? And I'll tell you, if you have adult children, they're probably going to vote for the never become a burden, because they're like you feel about the government Social Security. Like, I'm not really counting on it. Okay, so anyway, budget, priorities, these are the things you can really do a lot about. And having agreement with your spouse on this will give you a lot of comfort. Understand what your cash flow needs are. So this is going to help you with that decision of, should I delay the lump sum? Can I afford to delay the lump sum? If I understand my cash flow needs, I can be confident in making that decision when the time comes. And then understand your risk profile. Well, this is hard to do, because while you're working, it's really easy to ignore market fluctuations. But once you retire, particularly you take the lump sum, and this is all the money I have to live on the rest of my life, and it starts gyrating. I've gotten phone calls late Friday evening by somebody worried because, their couple $1 million just went down by 40,000 today in one day. Okay, so it feels different when you're retired. So it's hard to really understand your long-term risk profile, but it's certainly something to think about. And then you can think about what your withdrawal strategy is going to be relative to your cash flow needs, and how to structure those investments in a way that makes you feel very confident about your near-term cash flow needs. And you can afford to be a little bit more sanguine about the fluctuations on the longer-term assets. Okay, so upcoming events next week, I already mentioned we got Roth versus traditional 401k and IRA. I have no idea what we have the next 2 weeks, but I know we're going to have them every week. And so how can you get invited to all these if you're not already? So one thing is to say, you can go to this page and find recordings of all of our prior events. Okay, this one will be up within a few days. And on this same page, on the same video events page, over here on the right-hand side, it says subscribe for premium content. That's actually the way you subscribe to be informed of upcoming webinars, okay? Now, there would be another way to do it. And the reason you do it this other way is, in addition to these webinars, we put out a weekly email on interest rates, a weekly email on interest rates. To get on that, you would go to contact us, and in the leave us a brief message, you'd say, all I want is your weekly email on interest rates. And trust me, we're not going to bug you about anything else. Now, this one asks for your phone number and even says it's required. Nobody is going to call you unless you ask us to call you. Okay? You're absolutely just fine filling out this form if all you want, come on. If all you want is to be on the email for the webinars. Absolutely fine to do this one, and don't tell us your phone number. Okay, so it's kind of like, you know, why do we even do this stuff if we're giving it all away for free? And, you know, it's, I consider this corporate karma, that if we do good things for people, they'll say good things about us, and out of that will come new clients. Okay, so this is the signing up for future events, the right-hand side of the video events screen, or go to contact us and leave a note about what it is that you wanted. Again, really want to encourage you to come in for a one-on-one session. We can cover your specific concerns better than we can in a general webinar. And thank you. This is how to contact any one of the advisors if you want to contact us directly, as opposed to going through the website. If there's no more questions, oh, how much do we charge to manage retirement accounts? Okay, so what we charge is on a sliding scale. So if you're somewhere between $500,000 and $2 million that we're managing, it'll be a 1% fee. If it's smaller than that, it might be a little bit more. If you're bigger than that, it might be a little bit less. And to put this in perspective, not all of your money is going to be managed. Let me go back to this slide. It says 1.4 billion of assets under management. We're not managing 1.4 billion. We're managing 1.1 billion. Okay. So there's 300 million that we're not managing. That's the aggregate, right? So on average, you might say we're managing 70% and 30% we're not, but nobody's average, right? The population gives you averages. Individuals are whatever they are, which is anywhere from 0% managed to 100% managed. So it would depend on you. How much of your retirement assets are we actually managing? And, you know, everybody's different. Everybody's different. Okay, so a question, if I retire at 55, but defer the pension till 65, will I get the extra 5% increase in my pension? Okay, if you retire at 55 versus 56, you will get the extra 5% in your annuity. but your lump sum will not necessarily be 5% higher. It'll probably be 3% higher at 56 versus 55. So why is that? Again, it goes back to the fact that, yes, the annuity is for sure going to be 5% lower at 55 than it is at 56, but you'll get one more year of payments, okay? And that one more year is worth something, even though it comes at the end and it's only 50%, it's worth something. So you do not lose the full 5% if you're taking the lump sum. And because of interest rates, this is why you could lose that extra amount if interest rates go up. So if you're taking the lump sum, you really have to think about the timing and the interest rates. If you're taking the annuity, yeah, if you can afford to wait. Wait 2 years if you can afford it. Any other questions? Well, I'll thank you and hope to see you at a future one of these. So every month we'll be doing an update on interest rates. A lot of this will be redundant, but you'll get the latest numbers. Thank you for attending.